In this video, I want to continue talking about adjusting entries, and I want to talk about accrued expenses. This is when the business has expenses that they've incurred, but they haven't paid those expenses yet. So it's going to create a liability because they owe money for those expenses. And the reason why this comes up as an adjustment is at year end, the company would want to make sure they get all their expenses recorded on the books for that year. So if it's an expense they incurred that year, they'll want to have it on the books or in the accounting records that year. And what that's going to do is put those expenses on that year's income statement. So if you're in an accounting class, a couple of examples that you'll probably see are interest expense and salaries expense. So since those are common in accounting textbooks, I'm going to use those as two examples I'm going to do today. So the first example that I'm going to do is salaries expense. So for example, let's say you have a company and their employees work Monday through Friday and they get paid on Friday. And the company would normally record any expenses, any tax withholdings, and any payments out of checking or cash on that day, on payday. So I'm just going to keep this simple because this is focused on the adjusting entries. I'm going to ignore all the payroll taxes and payroll withholdings for this demonstration. But basically on payday, the company would debit salaries expense and credit cash or checking. So for this example, I'm going to use an easy even number that will be easy to calculate. Let's just assume that the weekly payroll is $5,000. So if you were to take $5,000 divided by 5 days for Monday through Friday, that's about $1,000 per day of salaries expense. But it doesn't get recorded until payday. Well, what can happen is if the company has their year end in the middle of the work week, they may want to record any salaries expense up to that day. So if you look at a calendar, December 31st, 2025 falls on a Wednesday. So if year end is on a Wednesday, they would want to record the salaries expense for Monday, Tuesday, and Wednesday because the company incurs salaries expense every day that the employees work. So you would want to go ahead and record what the employees have worked so far in that week. So you would want to record salaries expense for Monday, Tuesday, and Wednesday of that week. So if it's $1,000 per day for each of these days, that's a total of $3,000. And the adjusting entry would be very simple. You would have a debit to salaries expense and a credit to salaries payable. And that would be for $3,000. So this is your adjusting entry. And that's it. That's your adjusting entry. You're showing that they incurred salary expense of $3,000 in 2025, even though they're not going to pay until Friday. So 2 days later on Friday will be January 2nd, 2026. So that's why you're crediting salaries payable instead of cash, because you haven't gotten to Friday yet. And then that's, of course, going to change your entry on Friday when you actually write the paychecks and pay the employees. So let me erase this. So on Friday in 2026, on January 2nd, they would want to record the salaries expense for Thursday and Friday. They've already recorded Monday, Tuesday, Wednesday, and then in 2026, you've got Thursday and Friday. So you would debit salaries expense for $2,000. And then your salaries payable balance, you would want to clear that out. because now they're actually paying these salaries. So you want to zero out this credit balance. Well, if it was a credit before, you would want to do the opposite to zero it out. You would debit salaries payable for $3,000. So that debit will offset the credit and that balance will zero out. And then, of course, you would have a credit to cash for the $5,000 that they were actually paying to the employees that day. So what I'm going to do now is erase this so that I can do another example. Now I'm going to do an interest expense example. And if you're a business or accounting student, I would suggest that you know this formula because you're going to see it probably a lot. But basically, interest is calculated by taking the principal of the loan times the interest rate times the time period. So it's principal times rate times time. The principal would just be the amount of the loan outstanding. The interest rate is just going to be the interest rate that's probably given in the problem. And interest rates are usually stated in annual terms. So the time frame or the time is to factor in the fact that a lot of times you're calculating the interest for less than a year. So we're going to multiply by some factor related to the time period that we're looking at. Okay, so I'm going to do an easy example. Let's say the company borrows $20,000 at a 6% interest rate. And what would happen is they would record that loan payable or note payable, and they would receive the cash. So that would happen first. So let's say this is on December 1st. They would debit cash for the $20,000 that they receive in cash, and then credit loan or note payable for the $20,000. Okay, so we haven't calculated or done any interest yet at this point because they're just borrowing the money. They haven't incurred any interest expense yet. Well, by the time they get to year end, they've incurred some interest expense. So at year end, let's say year end is December 31st, they owe interest for this loan. Even if they haven't made any payments yet, they owe interest for that 1 month that's gone by. So you would have to calculate the interest that they owe up to that point. And the calculation is really easy. You would just use the formula. You would take $20,000 times 6% times 1 out of 12 months, or times 1 over 12. So you're dividing by a yearly term because the interest rate is stated as a yearly term. And the time period between December 1st and December 31st is 1 month out of that 12-month period of the year. So that is how you would calculate the interest. And if you do the calculation in your calculator, you should get $100 as your answer. So $100 is the interest that they owe for that loan outstanding up to year end. So you would debit interest expense for $100, and they haven't paid the interest yet, so you're going to credit interest payable. For $100. And that's all you would have to do. So let me fill this in. This is a debit, this is a credit, and this is your adjusting entry. And then in the following year, when they actually do pay the interest and maybe some of the principal or all of the principal, then they would want to factor in the fact that they've already recorded this interest in this year. So they wouldn't want to re-record the same interest for the same time period. And then they would also factor in the fact that they have this interest payable that they would want to zero out when they actually pay that interest. And that's it for accrued expenses. If you have any questions, feel free to comment below, and thank you for watching.